This is the third video in the Equity and the Distribution of Income mini-series, which is part of the Government Macroeconomic Objectives series. In this video, I'm going to talk about the role of taxation in achieving greater equity in the distribution of income. So let's get started. In order to understand the role of taxation in achieving greater equity in the distribution of income, we have to first distinguish between direct taxes and indirect taxes. Direct taxes are taxes on the incomes of the factors of production, so taxes on wages, interest, profit, and rent, or taxes on wealth. They are taken directly from people's incomes or wealth. Indirect taxes, on the other hand, are taxes on expenditure. So instead of taking the tax directly from your income, the government's going to wait until you go and spend it. So taxes on the expenditure on goods and services. Examples: sales tax, the value added tax, goods and services tax, GST, excise duties. Now, it is the direct taxes that may be used as a mechanism to redistribute income and to promote equity. It is generally direct taxes that are used to redistribute income and to promote equity. Now, when it comes to direct taxes, there are three types. There are progressive taxes, proportional, and regressive taxes. In this slide, I'm going to talk mostly about progressive taxes first, before I talk about the other two types. So progressive taxes are a very common way to redistribute income from higher income earners to lower income earners. Essentially, a progressive taxation system is, as income rises, a higher proportion or percentage is paid in taxes. If you earn $50,000 a year, you could pay 10% as a tax. If you earn $100,000 a year, you could pay 15% in tax. So the percentage itself also rises as income rises. This is called a progressive tax system. So how does it work? Essentially, what happens is you divide income into tax brackets. Okay, so here's the taxable income and here's the percentage paid in tax. Say, for example, if you earn between $0 and $15,000 in 1 year, your percentage paid in tax is 0. This is your tax-free income. So people earning anything below that don't pay tax. Between $15,000 to $25,000, maybe 20% is taken in tax. Between $25,000 and $35,000, maybe 25% is taken in tax. $35,000 to $45,000, 30% is taken in tax. Anything higher than $45,000, maybe you've got 35% taken in tax. So if a person earns $50,000, let's have a look at, say, a high school teacher that makes $50,000 in 1 year. The amount of tax will be, well, the first $15,000 will be taxed at 0%, plus the next $10,000 will be taxed at 20%, plus the next $10,000 will be taxed at 25%, plus the next $10,000 will be taxed at 30%, and this leaves the last $5,000, which is in that highest bracket, is taxed at 35%. Notice you are dividing the income into tax brackets. If you add all of that together, it should give you a total tax bill 0 plus 2,000 plus 2,500 plus 3,000 plus 1,700, which is a total tax bill of this much right here. Okay? Now, this is essentially how a progressive tax system works. So what would be the average rate of tax paid by this person? Well, you look at the total tax paid, which we just calculated, and divide it by the total income times 100. So the person paid a total tax of $9,250 divided by their total income, which is $50,000. That gives us 18.5%. So make sure you divide the income into tax brackets and calculate the amount of tax per tax bracket. Say, for example, this person receives an increase in earnings. They get a raise from work, or they get a promotion, and their income rises from $50,000 to $60,000. An exam question could ask you, what is the marginal tax rate or the marginal rate of taxation? How do we calculate marginal tax rate? It's the change, remember this triangle delta means change in total tax paid, over the change in total income times 100. So So the first 15,000 will be taxed at 0%. Remember the brackets that I showed in the previous 2 slides? So first 15,000 at 0%, plus the next 10,000 at 20%, plus the next 10,000 at 25%, plus the next 10,000 at 30%, plus the last 15,000 at 35%. This gives us a total tax paid of 12,750. We still haven't calculated the marginal tax rate. We'll do that in the next slide. So what's the change in the tax paid? Well, now they pay 12,750. Previously, when they were only making 50,000, they paid 9,250. So the change in tax paid is 3,500. The marginal tax rate, now we can calculate. 3,500 divided by the change in income, which is 10,000, because their income rose from 50,000 to 60,000, times 100 gives us 35%. So, to recap, average tax rate is total tax paid divided by total income times 100. Marginal tax rate is the change in total tax paid divided by the change in total income times 100. So we said progressive taxation is a system where as income increases, the percentage or the proportion paid in taxes also increases. A proportional taxation system is, regardless of the level of income, tax rate is fixed or constant. The percentage taken in tax is fixed. It's called a flat tax rate. So whatever your income is, the tax rate could be, say, 30%. If you make $10,000 a year, the government will take 30%. If you make $100,000 a year, the government will still take 30%. Now notice, as you're earning more money, if the income rises, the amount paid in tax increases. But essentially, the percentage or the proportion itself is fixed. It's a flat tax rate. Regressive taxation, on the other hand, is a situation where as income rises, percentage paid in taxes falls. You might be thinking, why would anyone do that? Well, unfortunately, these sort of taxes actually do exist. So these taxes fall heavier on the low income earners. Example, the VAT is a very good example. Sales taxes are another example. Sales taxes, excise duties, all these taxes on goods and services. If a rich person and a poor person are buying the same good or service, the tax will fall heavier on the poor person. It will be a bigger proportion of the poor person's income. So that's a regressive tax. Sales taxes are often regressive. So to wrap up, progressive and proportional taxation systems, they help in redistributing income. Okay? Unlike regressive taxes, progressive and proportional taxation systems help in redistributing income, because essentially the more you earn, the more you pay in tax, whether as a percentage or as an amount. But there is always a but. These taxation systems may also create disincentives to work hard, and therefore they may harm efficiency and economic growth if they are set at really high rates. And this is why progressive and proportional tax systems, it's very important for governments not to set the tax rate too low that you further increase the inequity in the distribution of income, or too high that you destroy incentives to work hard, which may harm efficiency and economic growth. Thank you very much, ladies and gentlemen.